Hi everybody, and welcome back to Fang Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and the Senior Portfolio Manager at McNichol & Associates Asset Management. Today, I'm going to focus in particular, on one of the FANGs, Apple. Apple is still the largest stock, if not the world, certainly the United States. Is it the eagle in the coal mine? It is way too big to be a canary. For the overall market? I'm not sure, but it is extremely widely held and may well dictate how many investors feel about the overall stock market. I trust that in doing so, I will offer you a different perspective on the valuation process that the market carries out. By the way, if you're interested in finding value stocks, not the FANGs, our methodology does provide a clear visualization of what those stocks look like, as well as how much you could make if you find the right ones. We recently had a client webinar where we went over this with our clients. Many found it very educational and, I dare say, valuable. So, to that end, we want to share this information with you, our non-client viewers, in a free public webinar that we will be holding in the near future. You will learn how to use our charts to find deep value stocks that, in our experience, can provide huge upside potential. You cannot sign up just yet, but stay tuned as details will be released fairly soon. If you're not a client but would like to watch the webinar on value investing, you can sign up by going to www.strategicanalysis.ca/pricing, and you will have access to the value investing webinar today. Of course, you will also have access to our entire suite of charts and valuation services that come with the service. So sign up right now. Anyway, right now, we really need to take a look at those FANGs and what has been going on. But, as always, before I do, I'd like to say thanks to everyone who likes these videos and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, well, we're going to start off with Apple. And what we see here is Apple having actually clicked off its HB7 price and has set back to its HB5 price down here, which is 33 times book value. And it is inflecting a little bit right now. However, as you know, yesterday or last night, Apple did report, and I'm not sure just exactly how excited one should be about Apple stock. Their sales were essentially flat, and even their forward guidance suggests that their fourth quarter sales year over year are going to be flat as well. Earnings ticked up a little bit, but nonetheless, you know, it's still leaving Apple at a fairly extended PE ratio of some 27 times, which for a company that is not growing, actually virtually not growing at all, begs the question then, what is this valuation doing up here? And the question is, why on earth doesn't Apple collapse? No sales growth to speak of, very high PE ratio. Surely the market can't be that stupid. Well, no, it isn't. But you can't analyze Apple by the usual conventional means. If you use SVA analysis, the answer is much clearer. And when I click on the price to book key under the chart, you will see what I mean. Share buybacks have been the key almost the entire key, by the way, to the high valuation that those shares enjoy. What happens is that as the equity on the balance sheet declines, the ROE rises, as shown by the dotted line on this chart. Now, the current ROE stands at 100%, which means that the equity per share on the balance sheet should double every year. And the question for you is, how much would you pay to own a stock that was growing at the rate of 100% a year? Well, when you look at the usual Apple chart, and let's just take off that, what we see is not a company that where the balance sheet is growing at 100% a year, is it? Indeed, it has been falling until fairly recently. But the current share buybacks, which will be about $24 billion, by the way, should bring that ROE trend back up again, which we will see next week when that third quarter balance sheet has been provided by our data suppliers. Anyway, right now, the shares are 100% overvalued, which you can see by looking at the fair market value potentially. Okay, 50% downside risk from here. Values may be miserable, but as I have said before, I don't argue with the market. You can trade this stock using SVA valuation indications, but you are not investing in any sense of the word. NVIDIA came down, and look at that, perfectly to its HB5, 33 times book value, and has bounced, has inflected here. And note, by the way, that coming down here, you had to be ready to buy the stock. You couldn't dither and thither and wonder, well, should I or should I not? You did or you didn't, because the stock is bouncing, and it's been moving up very strongly today. Amazon, now, the first two stocks came down to breakpoints and have been bouncing a little bit. Now we're going to find some companies that had actually fallen and actually given us sell signals, but have moved back up to their breakdown points and are actually, as we stand here, actually are breaking out again. And the first one is Amazon. The second one is Netflix. As you know, it's not a stock that I care for very much, but we can't argue with the market. The stock, after quite actually a setback, just leapt back up to its bubble price. That's 7.4 times book value on very strong results, and has been holding there ever since. Not necessarily running away, but certainly holding very, very strongly. Tesla, well, Tesla fell down to its HB2, which is 12 times book value, and then broke down from there. Well, guess what? The stock has bounced back nicely and is now trading a little bit above its HB2. Today, Tesla's moved up to 220, so it's still moving up and holding there. As you know, I am still very concerned about the fundamental outlook for the stock, and so I should be watching this one very carefully to see whether this little breakout here can actually hold. Alphabet, Alphabet broke below its mid-super growth price. That's 5.5 times book value. Has in this little rally, which has carried a number of the FANGs either up off breakpoints or up and through their top breakpoints, but Alphabet has not joined in this particular party, and actually now remains a confirmed sell. The confirmed sell being a 3% 5-day breakdown, 3% below the break point, holding for 5 days. So far, we've got no reversal of a buy signal here for Alphabet. And the same goes for Meta. Meta had struggled at its MSG price for quite a long while, actually, but has been falling away since then, and in this current rally has not actually been able to scramble back to its mid-super growth price and head higher, even though, as you can see, that the fair market value has been improving. And actually, look at that, we got a dead hit on its fair market value, breakpoint value. Finally, Microsoft. Well, Microsoft never gave us a clean buy signal by falling to its HB1, which is 9.5 times book value. They had excellent results. Of course, actually, so did Alphabet, but they had excellent results. But the stock hasn't exactly run away. It's just been sort of solidly soldiering forward. I am still not certain about this stock, although last week I did kind of raise the stock to a hold just because of the excellent technical action. Now, to briefly summarize what happened, the FANGs can be broken down into 3 categories. First, those which have fallen one breakpoint and are now inflecting right up off those key breakpoints, providing a nice trading opportunity. These are Apple, so far, but we will know better next week, and NVIDIA. Stocks like these are important to investors because they give us clean buy and sell signals, but clean buy signals, which is why I often admonish you to keep these breakpoints very much in mind. They all too often will hit and bounce, and you have very little time to make up your mind as to whether you will buy or just leave them for someone else. It's fill or kill, and you need to be ready to act when they reach a breakpoint. Number 2 are the breakdown, pullback kinds of stocks, but which are now doing more than pulling back to their key breakpoints. They look to be trying to break out again. These stocks are Amazon, Tesla, and Netflix. Please note that usually when this happens and you get a breakpoint, you also usually get a breakout pullback kind of pattern. That is, they'll come up to the breakpoint, break out, and pull back before they move on. So time tends to be more on your side here. Number 3, there are 2 stocks which have broken down, but are still a ways from reaching back to their breakdown valuation or a floor level at which we might make a trade. And these are Meta and Alphabet. And the best we can do is leave them for someone else with more conviction than we have. The last stock actually really is number 4 of 3. The one stock that is sort of enjoying a kind of a slow recovery, but never did give us a buy signal by falling to a major breakpoint is Microsoft. Having got its hands on Activision Blizzard, it looks to me as if that acquisition will be accretive to the overall Microsoft valuation. Last week, with some trepidation, I upgraded the shares to a solid hold, even though the fair market value measure is 42% below the current price. In closing, the general weakness of the FANGs, the powerful market leaders for so many years, was a concern. But things have perked up this week. So keep a close eye on the key FANG charts that I have pointed out, and let us hope for some follow-through. For now, this has been Ross Healy. the chairman of Strategic Analysis Corporation and the senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you next Friday.